Fine jewelry commonly carries a markup of 200 to 300%. A piece that costs $200 to produce can retail for 4 to 600. That sounds like one of the best margins in all of retail. And on paper, it genuinely is. And yet, net profit margins for jewelry businesses typically land somewhere between 10 and 20%. And plenty of new stores post a negative bottom line for their entire first year. Before you open a jewelry store, here's what nobody tells you. That enormous markup number and the thin profit number at the bottom of the page aren't contradicting each other, they're describing two completely different problems. One is about what you charge, the other is about everything standing between the sale and the money that's actually left over once the case is restocked, the marketing bill is paid, and the gold sitting in your inventory has quietly changed value while you weren't looking. By the end of this video, you're going to understand exactly why that gap is wider here than in almost any other retail business. Before we talk about money, let's talk about what a jewelry store actually is. A jewelry store is really three different product categories sharing one glass case, each with its own margin profile. Fine jewelry, precious metals, and genuine stones carries the richest markup, typically 200 to 300%, but also the highest per unit cost and the slowest turnover. Fashion jewelry moves faster and can carry even higher percentage margins, sometimes matching or exceeding fine jewelry's markup, but on a much smaller price tag. And custom or bespoke work, commonly a small slice of total sales, often delivers the best margin of all, 60 to 80%, precisely because it's priced around your labor and design skill, rather than a piece of inventory sitting exposed on a shelf. That inventory sitting on the shelf is the part most first-time owners underestimate. Unlike a shirt or a phone case, a piece of fine jewelry is essentially a stack of commodity metal and stone wearing a design, and its underlying value moves with global commodity markets whether or not you ever sell it. Here is where the range depends heavily on how serious a jewelry operation you're actually building. At the very lean end, a small specialty jewelry store can launch for $9,000 to $30,000, covering basic legal setup, a modest build-out, initial display cases, and a genuinely limited starting inventory. A branded mall location or franchise concept typically requires $150,000 to $350,000, reflecting both a more premium location and the brand standards that come with it. A full fine jewelry showroom, proper security systems, custom casework, and a real bridal-grade inventory depth can require $239,000 or more in fixed asset investment alone before a dollar of working capital is set aside. Here's the part that catches almost every first-time owner off guard. Inventory itself, not your lease or your display cases, is typically the single largest line item in your entire startup budget, commonly 30 to 60% of total capital, and a small starter store alone might need $40,000 to $100,000 in initial inventory just to make the cases look genuinely full rather than sparse. So you've built your cases, stocked your inventory, and technically you're now running a jewelry store. Congratulations. Before your first real sale, you have a set of problems that a normal retail business simply doesn't have. The first problem is that your inventory is directly exposed to commodity price swings you have zero control over. Gold prices hit record highs through last few years. Every piece already sitting in your case when that kind of move happens has its true cost basis shift underneath it, silently compressing the real margin on inventory you priced months earlier, whether or not you ever adjust the sticker. The second problem is that using one markup formula across every price tier is a genuine common mistake. A low-cost fashion piece might need a steep multiple just to cover shipping, payment processing, and customer acquisition cost. A high-ticket fine jewelry piece, by contrast, can only support a much smaller multiple before the price simply stops matching what the market expects to pay for that category, regardless of your actual costs underneath it. The third problem is that a huge share of your apparent profit gets absorbed by the layers sitting between the sale and your actual take-home. Payment processing fees, marketing and customer acquisition costs, packaging, and returns all sit between a sale ringing up and money genuinely landing in your account. And a business that only tracks its markup on paper without accounting for every one of those layers can look profitable while actually losing money. The fourth problem is that this business commonly loses real money in year one. And that's not automatically a sign something's wrong. Detailed operating models for new jewelry retailers commonly show a meaningfully negative bottom line in the first year, even while carrying gross margins above 80%, because high fixed costs simply haven't been spread across enough sales volume yet. Let's say you've solved the big problems. Now let's talk about what it costs every month, regardless of how many pieces sell. Rent and lease costs for a proper retail location can run a genuinely significant monthly figure on their own. Security systems and insurance add a real recurring cost, given how easily concentrated an inventory's value is inside a single showroom, and specialized labor. A bench jeweler for repairs and custom work, for example, adds meaningful fixed payroll even at modest hours. And this is the part that quietly separates a store on track from one heading for trouble. Because gross margins in this business run so high, often 80% or more before overhead, the entire question of profitability comes down almost purely to whether monthly sales volume has grown enough to cover fixed costs, not whether any individual sale was priced correctly. A detailed model for a mid-sized store might need to hit roughly $50,000 in monthly revenue before it turns a real operating profit, a specific, trackable number that matters far more than the markup percentage on any single piece in the case. Here is where the jewelry business gets genuinely interesting, because the number that gets quoted most often in this industry, the eye-catching markup percentage, is almost the least useful number for actually understanding whether the business works. A ring marked up 300% looks, on the surface, like one of the most profitable single transactions in retail. But that markup has to cover the metal and stone cost, the labor to source and design it, payment processing, packaging, the marketing spend it took to bring that specific customer through the door, and a share of the store's rent and staffing for every month that piece sat in the case before it sold. Layer all of that against the markup, and the number that's actually left over, the real net margin, commonly lands at 10 to 20%, a fraction of what the eye-catching multiple implied. Here's the number that changes everything. Gold alone reaching record price levels through 2025 and into 2026 means the cost side of that equation has been moving too. Not just once, but continuously, which means a markup calculated last quarter can already be quietly wrong today. A jewelry store that treats its markup formula as a set-it-and-forget-it decision, rather than something that needs repricing as material costs shift, is watching its real margin erode in real time without ever seeing it show up as an obvious mistake on any single sale. There are really two types of people who end up running jewelry stores, and their margins look almost nothing alike despite selling similar-looking product. The first is the inventory-heavy retailer, someone building a deep, broad selection of fine jewelry to browse and buy off the shelf, prioritizing selection and immediate availability. This owner captures strong markup on paper, but carries real capital tied up in slow-moving stock and real exposure every time commodity prices move against inventory already purchased. The second is the custom and service operator, someone weighting the business more heavily toward bespoke design, repairs, and made-to-order pieces, treating deep off-the-shelf inventory as a smaller supporting category rather than the core of the business. This owner ties up meaningfully less capital in inventory sitting exposed to commodity swings and captures the richest margin category in the entire industry, custom work, as a bigger share of total sales, even though this path typically means slower, more relationship-driven growth than a browse-and-buy showroom. Let's run the numbers on a mid-size fine jewelry store, open for $200,000. Let's start with optimistic scenario. Here the store maintains disciplined, tiered pricing across product categories, actively repricing as gold costs shift rather than leaving old markups in place, and builds a meaningful custom-design client base alongside its off-the-shelf inventory. Monthly revenue reaches $60,000 by year 2, comfortably above the roughly $50,000 break-even threshold. With gross margin protected through active repricing, net margin settles around 15%, and the store is genuinely profitable and growing. Talking about the realistic scenario, the store sets its pricing at launch and largely leaves it alone, treating the initial markup formula as fixed rather than something to revisit as gold prices continue climbing through the year. Monthly revenue reaches a similar $58,000 by year 2, close to the optimistic case on paper. But because inventory costs quietly rose without a corresponding price adjustment, real gross margin has compressed from the 80+% originally modeled down closer to 65%. And after the same fixed costs, net margin lands around 4%, barely profitable despite doing nearly identical revenue to the disciplined version of the same store. The difference between those two outcomes isn't how many customers walked in. It's whether the pricing kept up with a commodity market that never stopped moving. Owning a jewelry store is not simply a high markup business where an impressive multiple guarantees an impressive profit. It's a retail business with real inventory sitting exposed to a commodity market that moves independently of anything happening inside the store, where the gap between the sticker markup and the real net margin is wider and more easily mismanaged than in almost any other business in this series. The $9,000 lean specialty store and the $239,000 full showroom are the same business wearing different clothes. A bet that your pricing keeps pace with a metal and stone market that never agreed to stay still before an unrepriced markup quietly turns an 80% margin business into a 4% one without a single obvious mistake along the way. For the owner who treats pricing as something to actively manage against real material costs, not a formula set once at launch, a jewelry store can capture some of the richest margins available in retail. For the owner who trusts the markup number on the spreadsheet and never looks back, it's an expensive way to discover that the real margin was never the one printed on day one.